As usual at the start of a new month, it's the latest American jobs figures that will dominate the macroeconomic headlines in the week ahead. The US Bureau for Labour Statistics will publish the non-farm payrolls figures, which measure how many jobs were added or lost in the preceding month, on Friday the 2nd of April. Good Friday, no less. February's edition of 397,000 new jobs was widely seen as welcome good news, especially as the initial estimates for January were revised upwards for good measure. That also painted a slightly more optimistic picture than the weekly unemployment claims figures, which have just begun to flatline a bit. There are two other numbers to watch here. The first is the headline unemployment rate, known as the U3 number. In February, this was 6.2%, thankfully a long way down from the April peak of 14.8%, but a long way above last February's 51-year low of 3.5%. The second figure to note is the U6 unemployment rate. Now that includes discouraged workers, those who cannot work full-time even if they wish to, those who were underemployed, as well as the unemployed. This figure was still 11.1% in February, and US Federal Reserve Chair Jerome Powell has begun to acknowledge this in recent speeches. That's why Mr. Powell and his colleagues on the Federal Open Markets Committee are flagging that US interest rates could remain on hold at a record low of 0.25% until 2024, even while the Fed keeps running a quantitative easing scheme at $120 billion a month. It seems the Fed will not rest until America is back to full employment and inflation is at or above its 2% target. And yet, financial markets are getting edgy. We can see this in how the benchmark 10-year Treasury yield in the USA is rising, even as the Fed holds interest rates at their lows. This is the bond market's way of saying to the Fed, the economy might just be about to recover more quickly than it thinks, with the risk that inflation comes roaring back after 40 years in hibernation. This has got stock markets on edge as well. They like the economy at a Goldilocks temperature. Not so cold as to force profit disappointments, not so hot as to force interest rate rises that hit corporate profits and make cash and bonds more attractive relative to equities. It's a tricky balancing act that the Fed's got here. The corporate news flow will get a little bit quieter as we go into Easter, but there will still be some potential points of interest in the coming week. Companies which may be worthy of further scrutiny include the following, although these dates are still subject to change. FTSE 100 member and investment trust Pershing Square on Monday the 29th of March, Imperial Brands Pennon and AG Bar on the 30th, and James Halstead and Topps Tiles on the 31st. But the company which could really cause a fuss in the week ahead is Next. The multi-channel retailer is due to publish its full-year results on Thursday the 1st of April. Next shares have more than doubled in the past year despite the pandemic, 2 dividend cuts and multiple lockdowns. The strong relative showing owes much to Next's financial strength, the power of its online offering, as well as how results have exceeded expectations that were initially slashed in the wake of the viral outbreak. Next has consistently upgraded its profits forecast for the year, whereby it now expects pre-tax income for the year to January of £342 million, according to January's trading update. That comes after an additional £12 million profit from a 53rd week to the financial year, but also after a £40 million property value write-down. Now, that expected £342 million figure, expected by analysts, I should say, compares to £728 million in the year to January 2020, and Chief Executive Lord Simon Wolfson's estimate of exactly zero at this time a year ago, to give you some feel for just how much better Next has been doing than expected. Analysts will also look to Lord Wolfson's profit guidance for the new financial year. Back in the same January update, he offered a midpoint of flat full-price sales and a full-year pre-tax profit of £670 million as his best guess right now. The final point of interest will be the dividend. Again, Next announced back in April it wouldn't pay an interim dividend and would be unlikely to announce a final payment in January. Well, 28 FTSE 100 firms that cancel dividends have since recommenced them, and some analysts may be tempted to ask whether Next might be the same to do so. Intriguingly, the current analyst consensus forecast is for a full-year dividend of 33p a share, so they do think that Next will join the other 28. Now, that would be around £42 million. Also note that 8 FTSE 100 firms have launched share buybacks this year. There's no indication yet that Next will rush to join them, but do note that over the last decade, the retailer's paid out £2.1 billion in dividends and £2.2 billion in share buybacks. Those buybacks have taken the share count down from 181 million shares in issue to 133 million, effectively increasing a shareholder's stake by a third had they sold no stock at all back to the company. Hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.